Welcome to our video on bonds. Today, we'll be talking about what bonds are and how to invest in bonds. So, what exactly are bonds? In simple terms, a bond is a type of loan made to an organization, usually a corporation or government, with a promise to repay the loan with interest at a predetermined date in the future. When you buy a bond, you become a lender to the organization. In contrast to stocks, which represent ownership in a company. When you buy a stock, you become a part owner of the company. Other assets, such as real estate or commodities, represent physical property that can be bought or sold. Bond interest rates are the amount of interest paid by the organization to the bondholder. The interest rate on a bond is determined by a number of factors, including the creditworthiness of the borrower, the length of the bond, and market conditions. The relationship between bonds and interest rates is inverse. When interest rates rise, the price of existing bonds falls, and vice versa. This is because investors demand a higher yield on their investment to compensate for the increased interest rates. Bonds typically pay interest on a semi-annual basis, although some bonds may pay interest monthly, quarterly, or annually. The interest rate paid by a bond is usually expressed as an annual percentage rate, April, and is divided equally among the number of interest payments made each year. For example, if a bond has an annual interest rate of 6% and pays interest semi-annually, then the bond will pay 3% interest every 6 months. It's important to note that the frequency of interest payments may vary depending on the specific bond, so it's always a good idea to check the bond's prospectus or offering documents for the exact terms of the bond. Before we move on, please hit to click on the like button and also subscribe for free to our channel. By doing this, you can help the channel survive the YouTube algorithm and allow us to continue making more useful videos. So, how can you invest in bonds? There are a few ways to invest in bonds, including buying individual bonds, bond mutual funds, or exchange-traded funds ETFs. To buy individual bonds, you can go through a brokerage firm or purchase bonds directly from the issuer. Bond mutual funds and ETFs can be bought through a brokerage firm. There are several types of bonds. Here are some common examples. Government bonds are issued by governments to raise money for public projects such as infrastructure or to finance their budgets. They are generally considered to be low-risk investments because they are backed by the full faith and credit of the government that issued them. Corporate bonds are issued by companies to raise capital for business purposes, such as expanding operations or investing in new projects. Corporate bonds are typically considered riskier than government bonds because the creditworthiness of the company issuing the bond can vary. Municipal bonds are issued by state and local governments to fund public projects like schools and hospitals. They are generally tax-exempt at the federal level and can be a good option for investors seeking tax-free income. Junk bonds are high-yield bonds that are issued by companies with a lower credit rating or financial stability. Junk bonds offer higher returns, but they also come with a higher risk of default. Treasury inflation-protected securities or TIPS are government-issued bonds that provide protection against inflation. The principal of TIPS is adjusted for inflation, which means that the interest payments increase as the cost of living rises. Investing in bonds can be a great way to diversify your portfolio and generate income. Just remember to do your research and consult with a financial advisor before making any investment decisions. Thank you for watching our video on bonds. We hope you found it helpful. Till we see you again, take care and happy investing.